Meet Andre, a 38-year-old living in Germany. On paper, he's accomplished something many dream of. He's managed to save $300,000 through years of hard work, careful budgeting, and a disciplined lifestyle. Yet for Andre, this impressive sum feels less like a ticket to freedom and more like a heavy weight on his shoulders, a burden that brings anxiety instead of comfort. Despite his financial discipline, Andre finds himself paralyzed by indecision. He leaves his money sitting in a regular bank account, earning just 1.9% interest, a rate that barely keeps up with inflation, let alone grows his wealth. Each month, he watches his balance inch upward, but deep down, he knows it's not enough to secure his future. The world of investing feels like a maze to Andre, full of unfamiliar terms, unpredictable markets, and the ever-present risk of losing what he's worked so hard to save. The fear of making a costly mistake keeps him stuck in place, unable to take the next step. Every time he considers investing, he's reminded of news stories about market bubbles, sudden crashes, and people losing their life savings overnight. Memories of past financial crises, even those he only witnessed from afar, heighten his anxiety. Even investments labeled as safe seem fraught with hidden dangers. Like so many others, Andre's caution is rooted in a deep fear of loss. He clings to the security of his savings account, believing that doing nothing is safer than risking everything. But what he doesn't realize is that this hesitation carries its own risks, ones that are less obvious, but just as real. Financial planners often reassure clients like Andre that initial caution is not only normal, but healthy. It shows a respect for the gravity of financial decisions and a desire to protect what's been earned. But they also explain that staying in this state of hesitation can quietly erode future opportunities. Over time, inflation eats away at the real value of money left idle. What feels like a safe choice today can mean less purchasing power tomorrow. The cost of inaction is often invisible, but it accumulates year after year. The real challenge, then, is to transform that fear into motivation, a reason to learn, to plan, and to take small, informed steps forward. Instead of letting anxiety lead to inaction, Andre can use it as fuel to educate himself and build confidence. Andre's story is far from unique. All around the world, people with the potential for financial growth find themselves held back by the fear of loss. The emotional weight of what if can overshadow the possibilities of what could be. The journey to confident investing doesn't start with picking stocks or timing the market. It begins with understanding the hidden dangers of playing it too safe, recognizing that avoiding all risk can mean missing out on the rewards that come with thoughtful, long-term planning. It's about shifting perspective, seeing investing not as gambling, but as a practical tool for building long-term security and achieving life goals. With the right knowledge and support, even the most cautious saver can become a confident investor. The first step is simple but powerful. Acknowledge the fear, then take action to address the real cost of keeping money idle. For Andre and for anyone in his shoes, the path to financial confidence starts with a single informed decision. Andre's $300,000 feels safe in the bank, but inflation is quietly eroding its value every day. With interest at 1.9% and inflation higher, his money's purchasing power is shrinking, not growing. Over decades, this slow decline can devastate financial security. The Rule of 72 shows it would take nearly 38 years for his money to double at this rate, while inflation and taxes eat away at real returns. Holding large amounts of cash may feel safe, but it's actually one of the riskiest long-term strategies. The true goal of investing isn't just growth, it's preserving and increasing your purchasing power. To beat inflation, your money must work harder in assets with higher return potential. Before investing, the top priority is building an emergency fund, a financial safety net for life's surprises. This fund, covering 3 to 6 months of essential expenses, protects you from having to sell investments in a crisis. For Andre, that means setting aside enough to cover his basic needs, ideally in a high-yield savings or money market account. The goal isn't growth, but safety and quick access. Once this buffer is in place, the rest of your capital is freed up for long-term growth. Separating your safety net from investment capital is the foundation of sound financial planning. It's the first real step from fear to empowered action. With your emergency fund set, it's time to give your money a mission. Instead of letting your savings sit idle, you can now direct your resources toward building the future you envision. This is where investment goals come into play, turning vague hopes into concrete plans. Clear goals are your investment blueprint, defining what you want, when you want it, and how much you'll need. By setting specific targets, you create a roadmap that guides every financial decision, making it easier to stay motivated and measure your progress along the way. Short-term goals, which typically span 1 to 3 years, require safety and liquidity. These might include saving for a vacation, a new car, or building a small business fund. For these, you'll want investments that are easily accessible and less likely to fluctuate in value. Long-term goals, on the other hand, stretch 5 years or more and can embrace more risk for growth. These might include funding a child's education, buying a dream home, or building a retirement nest egg. With more time, you can weather market ups and downs and aim for higher returns. For Andrew, this might mean setting aside $50,000 for a home in 2 years, a clear, tangible target that shapes his investment choices and savings habits. And the rest of his savings can be dedicated to retirement, a goal that's 25 years away, allowing for a more aggressive, growth-focused investment approach. Writing down these goals brings clarity and purpose, turning abstract dreams into actionable steps. It's a powerful way to hold yourself accountable and track your achievements over time. This process transforms a daunting lump sum into manageable, goal-driven pools. Each pool represents a specific dream or milestone, making your financial journey less overwhelming and more organized. Each pool gets its own strategy: conservative for short-term needs, growth-oriented for long-term ambitions. This tailored approach ensures your money is always working toward the right objective. This structure keeps you focused and resilient during market ups and downs. When volatility strikes, you'll remember the purpose behind each investment, helping you avoid emotional decisions. Your goals are the why that keeps you on track. They remind you of what truly matters, whether it's family security, personal freedom, or a legacy for the next generation. Aligning investments with your life journey is the key to success. When your money is working toward your dreams, every step forward feels meaningful, and every milestone reached is a victory worth celebrating. For money needed in the next 1 to 3 years, safety is everything. Avoid risky assets. Focus on stability and liquidity. Money market funds and short-term government bonds are top choices. Low risk, easy access, and modest returns. Treasury bills, for example, are backed by the government and mature quickly, making them ideal for short-term needs. These vehicles protect your principal and ensure your plans aren't derailed by market swings. By insulating short-term funds, you gain peace of mind and can invest your long-term capital more confidently. This separation is a hallmark of smart investing. It turns a daunting process into a clear, manageable plan. For long-term goals like retirement, growth is the priority, and that means embracing equities. Stocks are volatile in the short run, but have historically outperformed other assets over decades. Instead of picking individual stocks, diversify with broad market ETFs or mutual funds, which spread risk across many companies and sectors. Target date funds are another simple option, automatically adjusting your mix of stocks and bonds as you approach retirement. Diversification reduces risk and makes investing less intimidating for beginners. The key is to invest in the market as a whole, not chase individual winners. Over time, this approach harnesses the power of global economic growth. Patience and diversification are your best allies for long-term success. Fear of market bubbles, like a potential AI crash, can paralyze new investors. But remember, one hot sector isn't the whole market. Diversification is your shield. Spread investments across industries, company sizes, and regions. Include bonds for stability. They often rise when stocks fall, cushioning your portfolio. Don't try to time the market or predict bubbles. Focus on building a resilient, globally diversified portfolio. There are always undervalued areas with growth potential, even when some sectors are overheated. Diversification prepares your portfolio for all seasons. It's about capturing growth and weathering storms, not chasing headlines. This approach keeps you invested and confident, no matter the market climate. Investing a lump sum all at once can be daunting. What if the market drops tomorrow? Dollar cost averaging, DCA, offers a solution. Invest smaller amounts at regular intervals, smoothing out your entry points. For example, Andrew could invest $25,000 each month for a year, reducing the risk of bad timing. DCA removes emotion and guesswork, making it easier to stick to your plan. While lump sum investing may yield higher returns on average, DCA's psychological benefits are invaluable for new investors. The best strategy is the one you can follow consistently. Gradual investing builds confidence and helps avoid emotional mistakes. It's a practical way to deploy large sums while managing risk. Navigating investing for the first time can feel overwhelming, especially when you're dealing with a significant amount of money and so many unfamiliar choices. The financial world is full of complex terms, unpredictable markets, and a constant stream of advice from every direction. It's easy to feel lost or anxious about making the wrong move, especially when your future is on the line. That's where a professional financial advisor comes in. They offer more than just investment tips. They provide personalized guidance tailored to your unique situation. A good advisor will help you clarify your financial goals, assess your comfort with risk, and build a plan that fits your life, not just a generic template. They can explain complicated concepts in simple terms, so you feel confident about your decisions. Advisors act as coaches and objective voices, keeping you disciplined through market ups and downs. When emotions run high, whether from excitement or fear, they help you stay focused on your long-term strategy, rather than reacting impulsively to short-term market swings. It's important to look for a fiduciary, someone who is legally and ethically bound to act in your best interest. Ask how they're compensated, whether it's through fees, commissions, or a combination, so you understand their incentives and can trust their advice. Don't hesitate to interview several advisors before choosing one. The right fit is about more than credentials. It's about finding someone you feel comfortable with, who listens to your concerns and communicates clearly. While there is a cost to professional advice, it's often small compared to the value you receive in strategy, discipline, and peace of mind. A good advisor can help you avoid costly mistakes, reduce stress, and give you confidence in your financial journey. With their expertise, advisors help you avoid common pitfalls, optimize your portfolio for growth and security, and adjust your plan as your life and goals evolve. Whether you're starting a family, changing careers, or planning for retirement. For new investors, partnering with a professional advisor isn't just about managing money. It's a smart investment in your financial future, providing support, education, and confidence every step of the way.